Every month, millions of people pay insurance premiums believing they are buying safety, but very few ever ask where that money goes once it leaves their bank account. What you are about to hear reveals how your protection quietly becomes someone else's power. Insurance is sold as a promise. You pay a small amount today so that if disaster strikes tomorrow, someone else absorbs the loss. Health insurance promises treatment. Life insurance promises security for loved ones. And property insurance promises rebuilding after destruction. This promise creates trust, and trust creates consistency. Premiums arrive every month, on time, predictable, and massive in scale. That consistency is what transforms insurance companies from simple risk managers into financial giants. Unlike banks, which rely on deposits that can be withdrawn at any moment, insurance companies operate with money that is contractually locked in for years or even decades. Life insurance premiums, pension-linked policies, and annuities create enormous pools of capital that cannot be suddenly removed. This stability gives insurers something banks desperately seek: long-term certainty. Once the premiums are collected, the money does not sit idle. It is immediately categorized, pooled, and prepared for investment. Only a small fraction is reserved for near-term claims. The majority is redirected into financial markets. Government bonds, corporate debt, mortgage-backed securities, infrastructure projects, private equity, and even hedge funds quietly receive insurance money. The policyholder believes the premium is paying for protection, but in reality it is financing governments, corporations, and financial markets worldwide. This is the first hidden truth. Insurance companies do not primarily earn profits from underwriting risk. They earn profits by investing your premiums before they ever have to pay claims. The longer they can hold your money, the more powerful they become. In effect, every insurance policy is a long-term loan from the public to the financial system. Issued without public awareness and without public control, how insurance money moves through the financial system. Once premiums are collected, insurance companies operate with precision and discipline similar to central banks. Teams of economists, portfolio managers, and quantitative analysts determine how every dollar is deployed. The largest share flows into government bonds because regulators label them as safe, liquid, and capital efficient. This allows insurers to meet regulatory requirements while still earning interest. However, safety is only the foundation. To increase returns, insurers move deeper into corporate bonds, funding multinational corporations, industrial expansion, and global supply chains. From there, the investments become more complex. Mortgage-backed securities turn insurance premiums into housing finance. Infrastructure investments transform premiums into highways, power plants, ports, and telecommunications networks. In recent decades, insurers have entered private markets, funding private equity firms, leveraged buyouts, and venture capital projects that the average policyholder will never hear about. This is where insurance companies begin to resemble shadow banks. They perform credit creation without issuing traditional loans. They influence capital allocation without public visibility, and they shape economies without democratic oversight. Unlike banks, they are not expected to provide daily liquidity to customers. Unlike hedge funds, they benefit from public trust and regulatory protection. This hybrid position allows them to operate quietly, steadily, and at an immense scale. In times of financial crisis, insurance money becomes even more critical. When banks pull back, insurers often step forward, buying distressed debt and stabilizing markets. Not out of charity, but because their long-term capital allows them to wait. The policyholder does not see this activity, but their money is actively shaping interest rates, corporate survival, and even government stability. The hidden system works because insurance feels boring, technical, and distant. That perception keeps the true power of insurers out of public debate. Why this system matters and what it means for the future. The transformation of insurance companies into shadow banks changes how risk, power, and responsibility are distributed across society. When insurers become major investors, their priorities shift. Claims management becomes a cost center, while investment performance becomes the engine of growth. This creates subtle but powerful incentives. Policies are designed to extend premium collection periods. Payouts are delayed through legal complexity. Products are structured to favor long-term accumulation over immediate protection. At the same time, insurers gain influence over governments and corporations because they are among the largest buyers of debt. Governments depend on them to finance deficits. Corporations depend on them to roll over bonds. Infrastructure projects depend on them for patient capital. This influence is rarely acknowledged, yet it shapes public policy, interest rates, and economic priorities. The risk is not that insurance companies invest money. The risk is that they do so without transparency, without public understanding, and without accountability proportional to their power. If insurers face losses due to market crashes, climate disasters, or systemic debt failures, the consequences ripple outward. Policyholders face reduced benefits. Governments face instability. Markets face sudden liquidity gaps. The illusion of safety collapses into the reality of interconnected finance. Understanding the hidden investments behind insurance policies is not about fear, it is about awareness. Insurance is no longer just a shield against misfortune. It is a pillar of modern finance, quietly supporting the same system that creates economic booms and busts. When you pay a premium, you are not only buying protection, you are participating in global capital markets. And whether you realize it or not, your financial security is now tied to forces far larger than any individual policy. Insurance was originally conceived as a tool for managing risk, a method by which communities and individuals could protect themselves against unpredictable disasters. In its earliest forms, insurance was simple and tangible. Merchants pooled resources to protect their ships from storms. Farmers combined savings to guard against crop failure, and families contributed to mutual funds to cover funerary costs. The concept was straightforward. One small contribution could prevent catastrophic loss for a larger group. Over centuries, this simple mechanism evolved into a sophisticated financial industry. Modern insurance companies now offer policies for life, health, property, liability, pensions, and even investment-linked products. From the perspective of the average policyholder, the primary function remains the same: protection against risk. However, beneath this familiar promise lies a vastly more complex reality. Insurance companies do not merely collect premiums and pay claims. They transform these premiums into vast pools of capital, strategically deployed across global financial markets. This is possible because, unlike banks, insurers deal with money that is often locked in for years, if not decades. Life insurance policies, annuities, and pension plans create long-term liabilities that are predictable in timing and size. The premiums paid by millions of individuals become a stable source of capital, capable of being invested in long-term ventures that banks cannot always support. Over time, this capability allowed insurance companies to move beyond their role as risk managers and quietly become some of the most powerful financial institutions in the world. What was once a safety net for individuals evolved into a mechanism for shaping markets, influencing governments, and controlling economic flows. The promise of protection remains the outward face of the industry. But behind that promise lies a web of financial influence that touches nearly every corner of the global economy. How insurance companies became financial powerhouses. The transformation of insurance companies into financial powerhouses is not accidental. It is a consequence of scale, predictability, and strategic investment. When a company collects premiums from millions of customers, it gains access to a pool of capital larger than most individual banks can command. This capital is invested with precision. The largest share typically flows into government bonds, which are stable and low risk, allowing insurers to meet regulatory requirements while earning consistent returns. Beyond government securities, insurance money fuels corporate debt, infrastructure projects, and even private equity ventures. By investing in long-term projects, insurers earn returns while simultaneously influencing industries and economies. Unlike banks, insurance companies are not required to maintain liquidity to meet withdrawals on demand, giving them a unique advantage in patient capital. This allows them to invest in long-term illiquid assets that yield higher returns. The largest insurance firms now rival the size of some national economies, holding trillions of dollars in assets. This scale gives them power not only in financial markets, but also in public policy. Governments often rely on insurance capital to finance debt, while corporations depend on it for expansion and development. In times of financial stress, insurers act as stabilizers, buying distressed assets and providing liquidity when other institutions retreat. This combination of trust, scale, and strategic investment is what transformed insurance from a protective service into a financial powerhouse. What the public sees is the payment of claims, but what remains hidden is the degree to which insurers influence the flow of capital, interest rates, and even economic priorities. By converting risk premiums into long-term financial instruments, insurers have become central players in the global economy, quietly shaping markets while maintaining the facade of modest risk management. The rise of insurance companies as financial powerhouses has profound implications for policyholders, investors, and the global economy. For the average individual, insurance is often perceived as a safety mechanism. Yet the reality is that premiums serve dual purposes. They protect and they invest. When insurance money is deployed across financial markets, it fuels infrastructure, funds corporations, and stabilizes economies. This is beneficial in many ways, as the long-term investment of premiums can generate higher returns and support economic growth. However, it also carries risks that are less visible to the public. Because insurance companies operate at such a vast scale, financial mismanagement, market crashes, or systemic failures can have consequences far beyond the scope of a single policyholder. A collapse in insurance investments could destabilize not only the companies themselves, but also the governments, markets, and institutions that depend on their capital. The transformation from risk protection to financial powerhouses also raises questions about priorities. When investment returns dominate the business model, insurers may focus more on profitability than on claim payments, subtly shaping the design of policies to maximize capital accumulation rather than immediate protection. This creates a delicate balance between financial growth and social responsibility. Understanding this transformation is crucial for anyone seeking to navigate the modern financial landscape. Every premium paid is not merely an expense for protection. It is an entry into a vast and interconnected system of global finance. Policyholders are, knowingly or unknowingly, participants in a network that directs trillions of dollars across markets, funds governments, and influences economic outcomes. Recognizing the dual role of insurance allows individuals to make more informed choices about policies, investments, and risk management. Ultimately, insurance companies are no longer just shields against misfortune. They are central architects of economic power, quietly steering the movement of capital across the world while maintaining the outward promise of security. Awareness of this dual role transforms our understanding of insurance, revealing it as a mechanism of both protection and extraordinary financial influence. The changing role of insurers in the financial system, insurance companies were traditionally viewed as institutions dedicated solely to risk management. Their primary responsibility was simple and clear: collect premiums from policyholders, pool the risk, and pay claims when necessary. Life insurance promised security for families. Health insurance promised treatment in times of illness, and property insurance promised protection against loss or destruction. However, over the past few decades, the role of insurers has transformed dramatically. The sheer scale of capital that insurance companies manage has made them formidable players in global finance. Unlike banks, which depend on deposits that customers can withdraw at any time, insurance companies typically deal with long-term liabilities. Life policies, annuities, and pension plans guaranteed payments far into the future, providing insurers with a predictable and stable pool of funds. This stability enables insurers to invest in ways that banks cannot, giving them access to higher yield and longer-term opportunities. It is this very capacity to mobilize massive amounts of capital over long periods that has allowed insurance companies to move beyond traditional risk management into areas traditionally dominated by banks. From corporate lending to infrastructure financing, insurers have found themselves occupying roles that once belonged exclusively to banking institutions. What was once a straightforward business model focused on mitigating loss has evolved into a complex financial operation that directly competes with banks in multiple sectors of the economy. The competition is subtle, largely invisible to the public, yet incredibly significant in shaping financial markets and influencing the flow of capital worldwide. How insurers enter banking territory. Insurance companies now operate in arenas that were historically reserved for banks because they possess three unique advantages: access to stable long-term capital, regulatory positioning, and expertise in risk assessment. Banks primarily rely on short-term deposits and loans, which requires them to manage liquidity carefully and maintain constant readiness to meet withdrawals. Insurance companies, on the other hand, have the flexibility to invest in illiquid, long-term assets such as government and corporate bonds, infrastructure projects, and even private equity ventures. This ability allows insurers to provide funding that banks are often unwilling or unable to offer. In addition, insurance companies have developed sophisticated analytical models to assess risk, manage portfolios, and forecast returns. These capabilities are not dissimilar to the credit analysis and investment strategies employed by major banks. Consequently, insurers can act as lenders, investors, and market stabilizers simultaneously. Another factor contributing to this competition is regulatory evolution. In many countries, regulatory frameworks have gradually allowed insurers to expand their investment activities, granting them the ability to hold large amounts of corporate debt and other financial instruments. This regulatory latitude, combined with the public trust associated with insurance companies, creates a powerful platform for financial influence. Over time, insurers have increasingly funded corporate expansions, purchased mortgage-backed securities, and participated in structured finance deals, effectively functioning as shadow banks. By doing so, they not only earn investment income, but also gain leverage over industries, governments, and markets in a manner that rivals traditional banking institutions. The distinction between banks and insurers has therefore blurred, with both types of institutions now operating in overlapping spheres of influence, competing for the same investment opportunities and shaping the global financial landscape together. Insurance companies hold a position in the financial system that is often overlooked. To the average person, an insurance policy is a safety net, a guarantee that life, health, or property will be protected against unforeseen events. In reality, every premium paid by a policyholder becomes part of a vast pool of capital. Carefully managed and strategically deployed, life insurance, pensions, and annuities are particularly significant because they involve long-term commitments, locking in funds for years or even decades. This predictability transforms insurance money into one of the most stable and powerful sources of capital in the world. Governments, corporations, and financial institutions are well aware of this strength, and they often rely on insurers to provide funding where other sources may be unavailable or less reliable. Unlike bank deposits, which may be withdrawn at any time, insurance capital can be invested in long-term projects without the need for immediate liquidity. This makes insurance money exceptionally valuable for financing large-scale investments, including infrastructure, energy projects, and public debt. In effect, policyholders unknowingly supply the fuel that drives markets, industries, and even entire economies. The money that individuals assume is simply safeguarding their future is, in reality, actively participating in the shaping of global financial flows, making insurance companies indispensable actors in the financial world. This dual role, as both protector and investor, grants insurers unprecedented influence over markets, often without public scrutiny or awareness. How insurance investments influence global markets. The influence of insurance money on global markets is both subtle and profound. Once premiums are collected, insurance companies invest them in diversified portfolios designed to maximize returns while managing risk. A significant portion is allocated to government bonds, providing liquidity and stability to national treasuries. Corporations also benefit, as insurers frequently purchase corporate bonds and private debt, financing, expansion, acquisitions, and operational needs. Beyond bonds, insurers invest in equities, infrastructure, and real estate, deploying capital in ways that directly affect employment, production, and economic growth. The sheer size of these investments allows insurers to shape market trends and even influence interest rates. When an insurer purchases a large amount of debt from a government or corporation, it stabilizes that entity's financial position and can lower borrowing costs. Conversely, changes in insurer investment strategies, such as reallocating funds or selling significant positions, can create volatility in markets that ripple across regions and sectors. Insurance capital also underpins long-term projects that banks are unable or unwilling to finance, such as renewable energy infrastructure, large-scale housing developments, and international trade initiatives. The resulting impact is substantial. Industries expand, governments gain stability, and markets gain liquidity, all driven by funds originating from individual policyholders. It is a hidden yet powerful feedback loop where consumer premiums translate into market influence. and insurers act as intermediaries between personal savings and global economic activity. Understanding this role illuminates why insurers are no longer simply risk managers. They are strategic investors whose decisions reverberate across the entire financial system. The centrality of insurance money in shaping global markets carries profound implications for economies, governments, and policyholders alike. On one hand, it enhances economic stability, providing consistent capital to projects and institutions that may otherwise struggle to secure financing. Insurance investments fund innovation, sustain corporations, and enable governments to meet financial obligations, thereby contributing to economic growth and societal development. On the other hand, the concentration of such influence in relatively few hands raises questions about transparency, accountability, and systemic risk. If insurers face significant losses due to market crashes, interest rate changes, or unforeseen economic shocks, the repercussions are widespread, potentially affecting policyholders, governments, and financial markets simultaneously. Furthermore, as insurers expand their presence in investment markets traditionally dominated by banks, their decisions increasingly affect capital allocation, sectoral growth, and even geopolitical economic strategies. For policyholders, this creates a paradox. Their premiums both protect them and place them indirectly at risk of market dynamics far beyond their control. Awareness of this dual role is essential. Recognizing that insurance capital shapes global markets not only informs individual financial decisions but also underscores the need for oversight, responsible investment, and careful regulatory frameworks. Ultimately, the world of insurance has evolved from a simple mechanism for mitigating personal risk to a cornerstone of global finance, directing trillions of dollars, influencing interest rates, stabilizing governments, and guiding the flow of economic growth. By understanding the hidden power of insurance money, individuals gain insight into how everyday financial choices connect to the broader economic ecosystem, revealing the profound and often unseen impact of their premiums on the world stage. The journey of your premiums. When most people pay their insurance premiums, they imagine that their money goes directly into a pool reserved to cover accidents, illnesses, or disasters. This is the perception that the insurance industry cultivates. Your payment equals your protection. The truth, however, is far more complex and fascinating. From the moment a premium is collected, it embarks on a carefully managed journey through financial systems that are vast, intricate, and often invisible to the policyholder. Only a small portion of premiums is set aside immediately to pay short-term claims. The remaining majority becomes long-term capital, invested across a variety of instruments and markets to generate returns that far exceed the original premiums. Life insurance, pension funds, and annuities contribute to particularly large pools of capital because their liabilities stretch over decades, giving insurance companies a predictable and stable foundation for investment. These funds do not simply sit idle in a vault. They are deployed strategically to create wealth for the company while maintaining the capacity to meet obligations. Governments, corporations, and infrastructure projects all benefit from this capital. Municipal bonds are purchased to fund highways, schools, and hospitals. Corporate bonds and private debt fuel business expansions, mergers, and innovation. The premiums you pay today are quietly shaping industries and public projects around the world, acting as a bridge between personal security and global economic activity. What begins as a simple act of protection becomes a powerful financial engine. With your money influencing markets, interest rates, and even government financing decisions in ways that few policyholders ever realize. The hidden investments and their global impact. The impact of insurance premiums extends far beyond local markets, touching the global economy in significant ways. Once pooled, premiums are invested in government securities, corporate bonds, equities, real estate, infrastructure, and sometimes even private equity funds. This creates a powerful feedback loop. Policyholder money funds businesses, finances public projects, and stabilizes financial systems, which in turn generate returns that are reinvested to grow the insurance company's assets. The scale of this activity is enormous. The largest insurance companies manage assets in the trillions of dollars, rivaling the size of national economies. Through their investments, insurers influence interest rates, corporate borrowing costs, and the allocation of capital across industries. They are often silent stabilizers of markets, stepping in to purchase distressed assets during financial crises. maintaining liquidity and confidence when other institutions retreat. In essence, your premiums act as both protection and investment, shaping financial outcomes at a scale that individual policyholders cannot comprehend. This dual role transforms insurance companies from mere risk managers into strategic financial powerhouses. Their decisions affect not only the markets in which they operate, but also global economic trends, employment levels, infrastructure development, and even national economic policies. By understanding where your premiums really go, you gain insight into the hidden mechanics of modern finance and the extraordinary influence that everyday contributions can have on the world stage. Your money is working quietly, continuously, and invisibly, participating in a global system that determines how capital flows, which industries thrive, and how societies develop over time. Understanding the value and responsibility of your premiums, knowing where your premiums go is more than just an academic exercise, it is a matter of awareness and empowerment. Your money is simultaneously protecting you and participating in one of the most influential financial systems in existence. It is invested in projects that fund growth, stabilize markets, and support governments. Yet it is also subject to risks inherent in global finance, including market fluctuations, economic downturns, and unforeseen crises. Understanding this duality allows policyholders to appreciate the true value of insurance while remaining informed about the forces at work behind the scenes. It also emphasizes the responsibility of insurers to manage these funds prudently, balancing the promise of protection with the pursuit of returns. As your premiums continue to circulate through these networks, they demonstrate how individual contributions collectively power the engine of the global economy. When viewed in this light, paying for insurance is not simply a routine expense. It is an act that connects you to financial systems, markets, industries, and even governments worldwide. Every premium is a small but essential thread in the fabric of global finance. By recognizing this, you gain a deeper understanding of the economic systems that govern modern life and the remarkable ways in which your everyday financial decisions ripple across the world. Insurance is no longer just about safeguarding against loss. It is a vehicle of influence, investment, and growth. Thank you for watching this video and exploring the hidden world behind your premiums. If you found this video informative and enlightening, do not forget to subscribe to our channel for more insights into finance, wisdom, and the forces shaping our world. Stay informed, stay empowered, and join us as we continue to uncover the truth behind the systems that affect us all.